Hello, everyone, and welcome back to the world's best investing podcast. What's happening with Duolingo now is that the market is confusing a natural slowdown in DAO growth. DAO stands for daily active users, for a disruption on behalf of ChatGPT. ChatGPT did disrupt Chegg, and I have a deep dive on that on the blog, so you can go and check it out. But what's happening here is different. Firstly, CFO Matt Skaruppa confirmed during the call that there is no deterioration of retention. Here's what he said exactly. He said, I think there was a question earlier on broader platform retention. That remains strong, so no real changes to that. So that sort of invalidates the thesis. But then if you look at the graph that I put on the screen now, you will see that DAO growth slowed down to essentially zero in Q2 2021. As I covered in depth in my original deep dive, that didn't happen for any particular reason. So essentially, Duolingo is always balancing user growth, profitability, and teaching quality. In other words, learner outcomes. And so at times they choose to focus on one variable or another. And sometimes they really focus on growth. And so what they did in Q2 2021 is they identified a metric, which I explain in depth in the deep dive, that they understood would drive disproportionate DAO growth. And so you can see how the line that stands for daily active users here in the graph literally plummeted over 2021 until June 2021, and then it went up brutally. And that's basically the result of Duolingo focusing on one metric and driving a lot of growth as a result. And so this teaches you two lessons, which is one, that Duolingo's growth is not linear. So this company and any other company doesn't grow in a straight line. It grows cyclically as they balance focus on these three priorities, which they're always focusing on, but they can't always be laser focused on growth. They have to get everything right. And then secondly, Duolingo has a history of identifying the metric that drives the most user lifetime value and the most value creation for the organization and executing on it successfully. So this is how they've become a cash machine. And we'll move on to that now. I'm going to show you how much of a cash machine this business is. But this organizational property is intact. This company is essentially a preposterous A/B testing machine. That's all they do. You could argue that's true for many other companies, which are very large today, Web 2.0 based. And these guys have just 50.5 million DAOs right now. And they're actually pointing at a multi-trillion-dollar opportunity in which they become the default operating system for the education market worldwide. And actually what they said during the call is, we're going to go into that now, but they said they're going to focus on learning outcomes a little bit now. Over the past few years, they've been focusing on monetization, and that's just after focusing on growth in the 2021 period. So the essence here, what the market is doing is overfitting. So the narrative with ChatGPT and everything is sort of combining with the relative slowdown, which is a fraction of what we saw in 2021. Then a year ago, everyone was delighted with this company, but a year before that, growth plummeted to zero. So you can see how you can't look at the numbers at a face value. Philosophically, what you have to understand for this thesis is that proprietary data is the moat of the 21st century. AI is going to get better over time. But if you have a data set, which no one else has, in terms of scale and quality, you're going to be able to train AIs to do things that others can't. And so what these guys have is a large proprietary data set, which enables them to understand how to motivate humans through any given learning experience. And you just can't beat them at that. An interview of Luis Van Aan, I think it was on the Acquired podcast a year ago, he said they solve 1 billion exercises per day. So that's a massive proprietary data moat. And we'll get deeper into that now, but I think everyone is missing the point. Now, if you look at the graph on the screen that I'm putting up now, you can see how free cash flow margin fluctuates. And what that summarizes is Duolingo's dance between focusing on user growth, profitability, and teaching outcomes. However, you can see that free cash flow margin, which by the way is impressive and indicates this is one of the best managed companies on the planet, continues to trend up with total revenues and cash from operations. So what this shows you is that as they shift their focus from one metric to another and they identify the one that maximizes user lifetime value most and therefore shareholder value, they can really make the business stronger over time. They make more revenue, So more money, they bring more of that to the bottom line and produce more cash, and they get increasingly better at yielding free cash flow. So you can see free cash flow margin was actually quite low in 2021 at around the 5 area level. In June 2021, it actually dropped to nearly zero. So you can see if you were to be overfitting for numbers back then, looking at them at face value, you would have missed out on a tremendous opportunity because this stock is up big time since. And then after that, you can see how it went from 0.9% free cash flow margin in Q2 2021 to 49%. That was a high in in Q1 2024. And then you can see how it's ebbed and flowed since. But basically, this is an exponentially stronger business now than it was back then. So Luis actually made a very insightful remark about this. And I think the market at large is not yet familiar with value creation processes. Firstly, in networks, this is a network. And then secondly, how that applies to AI. But when he was asked about how they are thinking about the number of words spoken per video, here's what he said. So yes, this is actually a great metric and we've managed to move it. This is important to know about our company. Whenever we fixate on a metric, we are very good at moving it. No wonder, look at this graph. And then he said, and this particular metric we have been moving at, it's more than doubled this year in terms of average number of words spoken per max subscriber. This is during the video calls with Lily. And so we're very happy with that. So the numbers fluctuate, and the market is relatively hysteric and is definitely being so right now. But ultimately what you're betting on is this organization that's able to isolate, so identify the metrics that create the most value, fixate on them, drive them up, and sort of continuously create more shareholder value. So obviously Duolingo and its value creation process doesn't really care much about the opinion of relatively emotional investors, and neither do end consumers. So as people make up narratives about why end consumers are not going to want to study languages, the truth is DAOs just keep going up. And this is because Duolingo is constantly monitoring student outcomes and doing whatever they can to improve them over time. This is why this company has been growing exponentially. And now, actually, during the call, Duolingo management said they are prioritizing teaching quality, so student outcomes, just before user growth, which they are now prioritizing just before profitability. So in my opinion, I really have no problem with this management team focusing on long-term value creation. And what's interesting, as CFO Matt Skaruppa said, is that actually this thing is going to have no meaningful impact in the financials. So he actually said during the call, the CFO, he said, we're guiding to a 29% adjusted EBITDA margin for the year, which is very, very close to our long-term adjusted EBITDA margin range. So really no impact. And all they're saying is we're going to focus on driving, we're going to prioritize, which it doesn't mean forgetting about user growth or monetization. He said we're going to prioritize teaching quality, which to me as a shareholder is great. And that's why I'm going to be buying more. So another example of fundamentals really not caring about the opinion of investors is the new energy feature that everyone was so concerned about. It's one of the things that made people quite emotional going into this earnings report, and which actually fundamentally has turned out to be great. So fundamentals great, investor psychology not so much. And we've seen this many times over the past few years, specifically this year with AMD. So here's what Luis said about the energy feature. He said, so energy, we're very happy with energy. It did exactly what we wanted it to do. It increased bookings and also increased DAO, so that was good. So you see how this machine doesn't care about your psychology as an investor. It's really just focused on delivering improved student outcomes. And to that effect, in 2022, a lot of investors were saying that Spotify was a dying music app because they were using Amazon's and Apple's equivalent services. And so the main lesson from that scenario, and obviously you would have made a killing if you had invested with me, which you shouldn't do because I'm not a financial advisor, back in 2022. But the main lesson would have been that your opinion, your experience as an individual user doesn't necessarily reflect the health of a network. So you can be using any of those services by Apple and Amazon, and then Spotify goes and makes a killing anyway. And that's exactly what's happened. And so with Duolingo, what you see is a lot of people saying, well, I haven't learned anything with this app. And the truth is, that's always been the case with any educational experience. There's always been a distribution of outcomes. You've always had a few people that excel, a lot of people that do kind of all right, have a sort of intermediate outcome, and then quite a bit of people that learn nothing. So all Duolingo has to do to take the entire education market and become the operating system that powers it is improve learner outcomes per dollar spent per cohort within the distribution. So it's tricky because it compounds on the network thing, which you as an individual don't have a holistic view. And then on top of that, there's also a distribution of outcomes which you need to factor in to form your view. So you can see how you really have to be quite familiar with the value creation processes. Now, Duolingo's value creation process is a direct function of the speed at which they iterate. This is just the machine which is A/B testing. And as I said, this organizational property is largely intact, which is the reason for which I'm going to buy more. Now, AI accelerates Duolingo's value creation process because it enables them to do far more, in a lot less time and at a much lower cost. And so, actually, Luis summarized this very elegantly during the earnings call. Here's what he said. We know that improvements in teaching do translate to user growth, but it's not immediate. And this is kind of what we mean by long term. What we're going to be looking at that there are things like just improvements in learning outcomes. We can measure how well people are learning. And pay attention to this because this is actually very revealing. And the good news is that really almost every year since we started measuring that every year, Duolingo is actually teaching better than the year before. So you see these guys have an eye on value creation processes, more than you do as an investor, certainly. And then he said, we're probably going to see improvements in how well we teach move faster than in the past because we are taking it, we're spending more effort on it. Basically, he was talking about AI, how that enables them to accelerate the value creation process. Therefore, if you look at the graph on the screen now, this is Duolingo has exponentiated free cash flow per share in medieval mode. So they've been creating, until very recently, content in manual mode, and that sort of did not enable them to do many things which they can do now, such as have an AI, having a video chat with customers, and there's a lot more innovation coming. But basically, we've seen free cash flow per share explode faster than Palantir, faster than HIMS, faster than pretty much any other company I'm invested in. Not pretty much, absolutely any other company. And probably faster than any other company on earth in this realm that's within my circle of competence. So what I think we see now is a further acceleration of this, simply because in the end, if you have a proprietary data moat, you're going to be able to offer a marginal user experience versus generic LLMs, which, as we know, tends to equate to an exponential advantage in adoption. And a lot of people say, well, this doesn't really have a moat, and it's not true. A lot of these platforms do have a moat. It's just a moat that the market hasn't learned to recognize. So these guys, every day they wake up, they are simply delivering more and more value per dollar spent to customers. And with AI, that sort of value to price ratio is going to exponentiate. It's going to be impossibly wide. It's going to be so wide that it's going to be impossible to replicate unless you have this compounding machine, which they have. And a lot of it is going to be driven by innovative features. So if the concern is competition versus generic LLMs, so long as you have more engaging features, which they do, you basically stay at the front end of the curve in terms of specialized data acquisition. So you're always going to enjoy talking to a specialized AI for something more than this, right? So it's like the HIMSS thesis. If you think that ChatGPT is going to be a better doctor than ChatGPT plus all of HIMSS's data, longitudinal over time from treating a lot of conditions across demographics and stuff, then it's wrong. It's a pretty obvious case. It's just that this one is sort of harder to see because of the distribution nature of things that I was talking about. And by the way, on the healthcare side of things, you also have a distribution, but it's less apparent. And the network isn't quite as big. So you don't have so many people saying that they haven't really achieved anything. So complex. Competition in the AI economy happens at the margin. But I think if AMD was a tremendous pick down at $80, $70 range, I actually think this is going to be 10 times better. And is so long as emotional investors continue sort of not focusing on the fundamentals, the attractive asymmetric nature of this pick is just going to keep going up. Of course, as you know, I don't have a problem recognizing when I think I've made a mistake. I don't see a mistake here. I think that this is going to be a tremendously successful pick, and a lot of people will be asking for proof about it. By the way, there seems to be no demand for additional proof at the moment. And we just hope that's the case when it succeeds tremendously. So guys, thank you very much for joining me. As always, you have the written form of the update in the blog. If you enjoyed this update, could you please share this with one friend? These deep dives and updates are for free, and so the only way this grows is with your help. So thank you very much in advance. Take care and see you next time.